The Federal Reserve just cut interest rates while inflation is still above target. Is this smart economic rescue or a $37 trillion gamble with your future? Welcome to Voice on Pages. Let's start to find the answer.
All right, so let's get right into it. What did the Fed actually do? Because this was a pretty big and honestly a very risky move.
Okay, let's put this in simple terms. When the Fed cuts interest rates, think of it like they're putting the entire economy on sale. It suddenly becomes cheaper for pretty much everyone, from a family buying a new car to a big company building a factory to borrow money. The whole idea is to get people and businesses spending and investing again, which, gives the economy a nice little boost. So on September 17th, 2025, they did just that. They cut rates by 1/4 percentage point. Now, I know that might not sound like a huge number, but this is the first time they've done this since way back in December 2024. It ended a long 9-month pause, and that signals a really big shift in their thinking. But what's really fascinating here is the language Fed Chair Jerome Powell used. He didn't come out and say the economy is in big trouble. Instead, he called this a risk management cut. It's kind of like preventative medicine for the economy. They're trying to stop a slowdown before it gets bad, not reacting to a crisis that's already here. And this comparison really shows you what he means. Think back to 2008 or 2020. Back then, the Fed basically slammed on the emergency brakes, slashing rates to zero because things were in a total panic. This time, it's a deliberate, calculated step. They see some storm clouds gathering, for sure, but we're not in the middle of a hurricane. At least, not yet. But here it is. This is the absolute core of the gamble. Right now, inflation is at 2.9%. That's still almost a full percentage point higher than the Fed's target of 2%. And normally, you fight high inflation by raising rates, right? Not cutting them. So the crucial question is, why on earth are they taking this risk right now?
The answer? In one word, jobs. You see, the Fed is constantly juggling two big mandates: keep prices stable, but also keep employment high. And right now, the job market is starting to look a little shaky. Unemployment just ticked up to 4.3%, and the economy only added a really weak 22,000 jobs in August. So the Fed basically decided that the risk to jobs has become bigger than the risk of inflation flaring up again.
So that's the high-level stuff, the Fed's big dilemma. But how does this decision actually trickle down and affect your personal finances? Let's get to the bottom line for your wallet.
All right, first up, mortgages. If you're hoping for a massive drop in your mortgage payment, you're going to have to be patient. Sure, this cut puts a little downward pressure on rates, but as of mid-September, the average 30-year fixed rate was still hovering around 6.35%. It helps, but it's not a game changer just yet.
And what about your other debts? Things like credit cards and auto loans. Well, the impact here is pretty modest, to be honest. Your credit card rate will probably drop by that same 1/4%. But if you have, say, a $5,000 balance, you're only going to save a few bucks a month. It's real money, sure, but it's not going to transform your budget. So when you boil it all down, who wins and who loses here? Well, in short, it's a great time for people with debt and for Wall Street, because borrowing just got cheaper. But it's a tough break for savers and retirees, since the interest you earn in your savings account is going to start dropping. This might actually be a good time to take a look at your own finances. Maybe look into refinancing if you have debt, or rebalancing your investments if you rely on that savings income. Now, moving beyond our personal bank accounts, this move kicks up some major risks for the whole economy. Let's peel back the layers and look at the controversies bubbling just under the surface. Okay, you knew this was coming. Let's talk about the elephant in the room, the U.S. national debt. It's over $37 trillion. That is just a staggering number, and every little change in interest rates has a massive impact on how much it costs the government just to pay the interest on that debt.
And that huge number leads to a really uncomfortable question, one that economists are debating right now. Are we stuck in a debt trap? See, some are arguing that the government simply can't afford high interest rates anymore. This theory suggests the Fed might be getting forced to keep rates low, not just for the economy, but to prevent the government's own budget from spiraling into a crisis.
The risks here are significant. I mean, cutting rates too soon could just pour gasoline on the fire of inflation they fought so hard to put out. It could also pump up new bubbles in the stock market or in housing. But maybe the biggest risk of all is to the Fed's own credibility. If people start to think they're just caving to political pressure, it really weakens their power to manage the economy down the road. So, with all these massive risks on the table, what happens now? Where do we go from here?
while the Fed has given us a few clues about where they might be headed.
Look, this probably isn't a one-and-done deal. The Fed's own forecast is signaling that they're planning 2 more cuts this year. So what's the takeaway? They're getting ready for a longer-term economic slowdown, and they're trying to get ahead of it by bringing that key interest rate down to around 3.75%.
So how are we going to know if this huge gamble is actually working? Well, if you want to follow along, you need to keep your eye on 3 key signals. First, the monthly jobs report will tell us if the labor market is holding up. Second, the inflation data will show us if they cut too soon and prices start taking off again. And finally, you have to listen very, very closely to what the Fed officials say in their statements for any clues about their next move.
Do you think the Fed made the right call, or is this the start of a bigger crisis? Drop your thoughts in the comments. And if you want clear breakdowns of how global finance really affects you, don't forget to subscribe.